Hello, namaste, and a very good evening to everyone. Welcome to the November edition of our Equity Market Insight webinar. I am Sonal Mittal, Product Specialist at UTI, and I'll be your host for this session. To help us decode the latest market developments and understand the road ahead, we are delighted to have with us Mr. Vetri Subramaniam, our MD and CEO designate, who will share his perspectives on the markets and macros. Following that, Mr. Sharwan Goel, Fund Manager, will walk us through the investment approach and strategy of UTI Quant Fund. As always, we encourage you to share your questions anytime using the link provided, and we'll be happy to take them in this session. With that, let's turn back to Vetri. Vetri, the
Sure.
US market, yeah,
Yeah, go ahead, Son.
yeah. The US market seems to be getting increasingly concentrated, with the Mag 7 stocks dominating the show. What's your take on this trend?
Sure. Good evening to everybody who's joining us on today's webinar, and I'll kick off with answering Sonal's question. And we have some slides which will sort of help navigate this topic. So, Sonal, if you can just bring up, the deck.
Sure.
Right. So, absolutely true that, the Mag 7, which is essentially the bunch of companies which are primarily being seen as the drivers as well as the beneficiaries of the artificial intelligence boom, are the ones which are leading the market higher. If you look at the slide, what you'll see here, this is the UBS's in-house Mag 7 index. And if you look at it over the last 3 years, almost last 3 years, because this is 23, 24, and the first 10 months of the current year, the annualized return of this index is 50%. It's up 222% in absolute terms. During this period, the S&P 500 was up 86%, or an annualized return of 24%. But remember that the Mag 7 now make up almost 1/3 of the S&P 500. So in a sense, the strong performance of the Mag 7 is feeding into the S&P 500 as well. So if we just take a different prism to look at the market performance, and we move away from the S&P 500, which is a market weighted index, to the S&P 500 equal weighted index, in which every stock would have an equal weight. So the Mag 7 would make up a much smaller percentage of that benchmark as compared to the S&P 500 market cap weight, where it makes up almost 35%. So that benchmark has delivered only a 13% return over the last 3 years. So you can see that difference. The performance of 7 stocks delivering 50% per annum is pulling up the benchmark to 24%. The equal weighted is up only 13% per annum during that period. Another way to look at this is visible on the next slide. So you can see here what it has meant in terms of valuation. So the blue line that you see is the S&P 500 trailing PE ratio, and the orange line that you see is the S&P 500 trailing price to sales ratio. Now, it is true, and many people have pointed out, that during this artificial intelligence boom, these are essentially profit-making companies whose valuations have moved higher. And you can see that in the blue line, which is the PE ratio. The PE ratio of the S&P 500 is actually below the peak that the PE ratio hit during the dot-com boom of the 2000s. So in the dot-com boom of the 2000s, the PE was almost close to 30 times. This time it is still south of 25. So in that sense, it is not as costly. However, if you take another measure, which is the price to sales ratio, which looks at the market cap relative to the total sales of the S&P 500, that's the orange line. And as you can see, that orange line is actually making a new high. So it is true that the S&P 500 is not being pulled up by loss-making companies as it was pulled up during the 2000 boom. But at the same time, when you look at it on a sales basis, this is one of the costliest markets ever in US history. So US valuations have certainly reached new highs when looked at on price to sales ratio. Now, a question you could ask is, Vetri, how come it's expensive on price to sales but not on price to earnings? The answer to that lies in the next slide. which is to say that the S&P 500, and once again, the S&P 500 led by the tech companies. So on the left hand side, you have the profit margins of tech companies and semiconductor companies, which are in the blue line, and US semis profit margin is in fact in the black line. So if you look at that, you will see that both these lines have accelerated very dramatically. So from about 2016, the tech profit margin goes up from almost 20% to 40%, and in semis, the profit margin goes up from about 15% to 25%. So these two sectors are a very big part of the S&P 500, close to almost half of the US stock market in market cap terms. And because their profit margins have surged, as a result, it has pulled the S&P 500 profit margin higher, and therefore it has in effect also pulled up the profits of the S&P 500. So once again, to reiterate, when you look at the US market, it is being dominated by the performance of the Mag 7, which are the companies which are drivers and beneficiaries of the AI boom. These are profit-making companies. Their profit margins have gone through the roof. So the P ratios don't seem as elevated, but the price to sales tells you that the valuations in that segment are quite elevated. So Sonal, in a nutshell, that's the story of the US Mag 7 and how it is dominating the performance of the US market.
Sure, Vetri. The another indicator to gauge US economy is the labor data. So how do you read the current job situation and what does it tell us about the underlying health of US economy?
Sure. So we can move to the next slide, Sonal. This will show you the US job data. And as you can see, the US is actually on two different tracks right now. Anything to do with AI is booming, and that is also a driver of the economy. But on the other side, we are starting to see a increase, at least in terms of job cuts. So what you're seeing here is the challenger job cuts ex government. And remember, the government has also been laying off people in recent times. And as you can see over there, as we come out of the pandemic, job cuts really go down. But now it has picked up quite dramatically. And in fact, it is going up almost to the levels that we last saw during the global financial crisis. So in that sense, it is a matter of concern that there is a section of the US economy which is booming. It's driving the US economy. But on the other side, this is not creating jobs. And in fact, job cuts are going up. And in addition, the government, which was the biggest contributor to US jobs in the last few years, is actually backpedaling. So Sonal, if you look at AI data, you'd be very positive on the US economy. If you looked at the labor market, you'd be worried about the US economy.
Right. Turning to India, Vetri, inflation seems to be easing further. What, in your view, is driving this moderation and does it create any room for the MPC to consider rate cuts?
Very good question, Sonal. We can see the chart on inflation, and the inflation data has plunged so sharply, as you can see on the left-hand side, that it's almost reached the zero line. Now, there are multiple reasons for this. First of all, there's been a sharp decline in food prices, and that has really, contributed significantly. But remember, many prices have also been cut for goods starting from September, when many manufacturers started to cut their prices ahead of the GST rate cut. And then, of course, in October, GST itself caused many prices to come down. So as a result of all of these cyclical or in some cases one-off elements, point-to-point inflation on a year-on-year basis has dropped to 0.25%. On the right side, you can see core CPI. And this time, in fact, we've had to do two core inflations, because one is the traditional core inflation and the other is the core X gold. And if you look at the orange line, that's core inflation. So that still seems slightly elevated at 4%. But remember, gold prices also feed into inflation, and gold and silver are up very strongly over the past 1 year, almost 50 to 60%. When you strip that out, what you see is that core inflation is running at a very comfortable 3%. Now, of course, you could argue that does core really matter, because you've excluded food, you've excluded fuel, and now you've also excluded precious commodities. But it just shows you a trend, which is to say that there is still core inflation. Don't go purely by the CPI inflation, but even on core inflation, the economy looks in fairly good shape. And I would say without doubt that this print of inflation certainly will cause the RBI and, more importantly, the MPC to think much harder about its policy action in December. Sonal, you're on mute.
Yeah. Have the recent US tariff measures had any meaningful impact on India's export performance, or has the economy managed to stay relatively insulated so far?
Sure, Sonal, we can look at some data on that. Now, point number one, Sonal, is, and we've discussed this many times in our conversations here on the monthly market insight. The fact of the matter is that our goods exports to the US are such a small portion of the economy. $4 trillion economy, $85 billion of goods exports to the US. And actually, the portion of exports which are impacted by tariffs is basically estimated at about 40 to 50 billion. That's 1% of GDP. So honestly, it doesn't really impact the economy too much. But on the left hand side over here, we have also looked at just goods exports for India as a whole, and goods exports to the US. When you look at that, you can see that there is definitely an impact of US. Now, there were concerns about Trump's tariff policies. So you can see that on year basis, exports to the US before the tariffs came in had jumped to almost, like a 20% level. But then as the tariffs kick in, exports to the US start to collapse, and we are in negative territory on a year basis for US merchandise exports. But when you look at aggregate India goods exports, that's the blue line, what you will find that it is remaining reasonably stable. So I think that really reflects the fact that in a way, Indian goods exports have held on reasonably well, despite the fact that Indian manufacturers, amounting to about $50 billion of exports to the US, are still facing a challenging situation. I do think this will get resolved sooner rather than later, but this is really the fact. It has not really impacted total exports of India as much so far. On the right-hand side, we have India's services exports. This has also been sort of weak for the last 1 year, but just recently we've started to see a little bit of a pickup, and that is good news. But net, when you look at all of this, I would say that the good news for India is that the tariffs have not really impacted, and I will say this as well. That's exactly what we have been saying for a while now, that look, India's exports to the US on goods are so small that it really doesn't move the needle, but it's still heartening to see how well merchandise exports and to the whole world have held up quite reasonably for India.
Sure. With the second quarter result season largely behind us, how would you assess the overall earnings performance? Have the numbers lived up to the market expectations so far?
Sure, Sonal, we can just, dive into the next slide, which will show you that this is really a longer term trend line of Nifty 500 companies. And what we are interested in this data, or rather what this chart is plotting, is what percentage of the Nifty 500 companies have year-on-year revenue growth more than 10%, year-on-year PAT growth more than 10%. So you can see that coming out of the pandemic period, FY24, well outside the pandemic period, actually, to be honest, both PAT growth and revenue growth, almost about 55 to 60% of the companies were delivering revenue and PAT growth well about 10% year-on-year. But you can see that that trend line is gradually coming down over time. And for the data that's available so far for Q2 FY26, less than 50% of the companies have profit growth of greater than 10% year on year. As far as revenue is concerned, the percentage of companies which have revenue growth more than 10% year on year is slightly more than 50% of the sample of companies. At this point of time, I believe we have reports for about 310 companies out of the total Nifty 500 companies. So there is a majority of companies, we could argue, who are just about managing to deliver 10%. So half of them are below 10% year on year profit and revenue growth, and half of them are about 10%. Keep in mind that nominal GDP growth in India is currently running at about 8 to 9%. So that becomes a challenging environment for companies to be able to report strong revenue growth, though margin improvements can sort of help slightly more in terms of profitability, but also makes it more difficult if there are margin headwinds.
Sure, Vetri. Given the past year's consolidation and India's relative underperformance versus other emerging markets, how do you see India's valuation picture evolving now?
Great question, Sonal. We can see this on this slide. India has always traded at a premium to emerging markets, and many global investors that we talk to, because UTI manages almost $3 billion of assets for global investors, always talk to us about the EM premium. And as you can see on the left-hand side chart, India has typically always traded at a premium, right? So the last 10 years data is there. You can see the lowest premium was about 20% and the highest premium was 100%. So on average, it's somewhere close to 60%. Right now, we are back to that average number. So in a sense, some of the excessive valuation premium has been written off. Now, very hard to argue whether it can go down or it can go up from here, but certainly some of that excess premium has been eroded, partly because we have not done much over the last 1 year, while earnings have gone up in single digit terms. Equally, many other markets around the world, particularly EM markets, be it Korea or Greece or China, are all up 30, 40, 50, 60%, and that's caused their valuations to move higher. So effectively, our premium has come down. The other reason this premium is down is, if you look at the right-hand side chart, at this point of time, the FY26 EPS is still estimated to grow at about 16%. This is the FTSE India 2026 earnings. So it's a slightly different sample from the Nifty 50 that we'll talk about later, but it's not very different for the Nifty 50 at about 16% growth. So the one caveat that I would have is that it is difficult for corporate India to deliver 16% earnings growth when we have got nominal GDP growth in the 8 to 10% range, unless you see strong margin expansion. So I would not say this is a high bar, and to the extent that we may be worried about the potential for 16-17% earnings growth, you need to be cautious about the premium on the left-hand side coming back to average. But certainly compared to history, we are now back at the historical level of premium. Now we'll have to depend on India's ability, which it has demonstrated over nearly 20 years, to be able to consistently generate much higher earnings growth outcomes compared to other parts of the EM basket. So it's down to earnings delivery at this time to justify the premium to other EMs.
Thank you, Vetri, for those nuanced insights. I would now like to invite you to share your thoughts on market valuations and how they look at this stage.
Sure. Thank you, Sonal. So we'll just run through the normal set of decks. So this is, 1 month, 3 month, 1 year performance. If you look at the extreme left-hand side, there's been some pickup in the performance of the, mid-cap and small-cap index. But if you look at it on a 1 year basis, which is the extreme right-hand side, you'll see that the Nifty 50, the large-cap index, has 6.3% year on year. Mid-cap 100 still keeping pace at 6.6%. But Nifty small cap index, which was otherwise the best performing index a year or little more than a year ago, is now among these market cap indices the worst performing. Interestingly, the other worst performing the index among the indices is the Nifty Next 50, which is minus 1%. What's leading performance among sectors? Well, if I were to combine it, if you look at the lower right side of this deck, you'll see that PSU banks, financial services, banks and private private banks. So obviously the financial services index includes banks and private banks and other non-bank financial services businesses. That is the best performing part of the market, up 13.6% year on year, twice the gain of the Nifty 50. What's worst performing, if you ignore a small sector like media, is actually the IT sector, which is down 11%. So that's been the worst performing. Also underperforming significantly is energy and real estate. So it's really the banks which have been holding up at the forefront, and you've also got some parts of consumption which have done reasonably well. Among other key sectors is auto, which again is a part of the consumption basket. If you move to the next slide, this shows you the performance on a one-year basis. I'll just focus on the extreme right-hand side 1 year. As you can see, this has been a very strong year. This is, of course, performance in US dollar terms. So you can see EMs have had very strong performance. Even some developed markets like Germany, Japan, very strong performance. UK, again, doing very well. And India really coming up there at the bottom in terms of its one-year performance. And maybe this is a function of the weakness that we've seen in earnings growth over the last 2 years, and so much more excitement in some other markets around the world. Moving on to the next slide, this once again talks about earnings. So remember, just to put things in perspective, India's strong earnings growth acceleration came during the period March 20 to March 24. So during this 4-year period, earnings grew at a CAGR of almost 19%. So during this 4-year period, a CAGR of 19% in earnings effectively means that earnings sort of doubled during this period. Coming off that doubling of earnings, it's been far more modest. 25, we had earnings growth for the Nifty 50 of 3%. For March 26, the estimate is now at 8%. And for next year, the earnings estimate is 16%, which I mentioned earlier, even for the FTSE index, was about a 17% number in terms of earnings growth. This is a little bit of a high bar. We are looking at the Nifty 50 because of the recent changes that happened in the Nifty, or rather a few months ago. You could say that there is a pulling down of earnings estimates for 26 and a automatic increase in the percentage growth estimates for March 27. But net, I would still say that the bar for 27 remains slightly high, which is delivering 17% earnings growth when nominal GDP is running at 8 to 10% is slightly hard to do. Jumping through to the next slide. These are the regular valuation slides that we look at. So on the left-hand side, you have the Nifty 50 trailing PE multiple. The white zone is what we call the fair value zone, and you can see it's within the fair value zone. The forward PE multiple is still in the expensive zone. This is looking at the next 12 months earnings. Remember, in the next 12 months, earnings are expected to grow 16%. So in a way, markets are expensive, and this is already getting captured in the forward PE multiple. Next slide, price to book multiple. This is where you can take a little bit more comfort. Again, the white zone is the fairly valued zone. The yellow line is the average, and the market came down to the average and it has bounced off that average in the last few months, but you're still comfortably in the white zone, which is the fairly valued zone. Correspondingly, on the right side, you can see the Nifty 50 ROE, and from its trough in 2020, you can see that for 4 years it rises to almost about 16-17%, but now it's starting to cool off, which is also a function of perhaps more companies putting money into investments, and therefore that sharp recovery in ROE is perhaps now behind us. What does it look like for the price to book ratio on mid caps and small caps? That's on the next slide. Here the picture still remains fairly challenging. Left hand side, Nifty mid cap trailing price to book still in the very expensive zone. Same is true for the Nifty small cap, and both the small cap and the Nifty 150 mid cap 150 both trading at a premium to the Nifty 50, and which is what in a relative sense gives us more comfort in large caps. Moving on to the next slide, this is where we look at bonds versus equities. The signal was very clear in favor of bonds some time back, but now we have, sort of moved into a territory where it's come closer to the average. So we are still in fixed income favorable territory, but not as dramatically so as, the worst point on this benchmark, which was in September 2024, when it was ambiguously suggesting that fixed income was more favorable. We are still in that favorable zone, but we did trend higher towards the baseline for a few months. Now, I've talked about price to book, we've talked about PE ratios, we've talked about bond yields versus GSEC yields. How can we combine all this together into a single indicator? That's what you'll see on the next slide. This is our single equity valuation index, which looks at PE, it looks at price to book, it looks at dividend yield, and it looks at bonds versus equities. It combines all of these together to create a single index, equity valuation index, and the colors over there and the text that you see over there gives us a sense of what should we be doing with our equity allocation. The black line, which is the indicator, came into the green zone, which is the increased equity allocation zone. It's moved up. It's almost at the border between fair value and increased equity allocation at this point of time. So that is something to keep in mind. And remember, this benchmark is based on the Nifty 50. So this is really a guide to how should we think about asset allocation in the context of large cap stocks. It does not look at mid cap and small cap valuations. So in large caps, we are still in that borderline between increased equity allocation zone and fair value for equity allocations, which is why we think a staggered process is most desirable at this point. What would the outcomes have looked like for an investor on a one-year basis? You can see that on the next slide. When somebody invests in the increased equity allocation zone, that's the second set of bars from the right, the average one-year return has been 14%. The best return was 52% on a one-year basis. The worst return was minus 21%. And the number of observations in this period are 202 observations, which is 31% of the total observations. Negative returns you would have earned on a one-year basis only 6% of the time. So, the odds are still, in a sense, in favor of the investors, and 57% of the time your average return would have been better than 12%. So in that sense, that's the, attractiveness of why we think staggered investments make sense in this environment, but very clearly only for large caps. Moving on to the final slide for today, which summarizes some of the facts that we've talked about. Well, most importantly, or something I didn't mention so far, is that China and US have reached a negotiation on their trade deal, applicable only for 1 year. But fact of the matter is that this has brought the effective tariff on China down to, or rather the headline tariff comes down to about 35%. Average tariffs are more in the 20% range. Technically, at this point of time, India's tariffs are actually higher because of the 25% penal provision. But I do think an India-US deal announcement is now close by, and that should be positive for sentiments. But remember, in the big picture, for the same reason that I said the tariffs are not really hurting the economy, neither will its lifting really turn things around for the economy. But from a sentiment point of view, that would be good. The Fed has announced the end of quantitative tightening. Why is this material? Remember, when the pandemic happened, the Fed engaged on quantitative easing by pumping money into the economy, by buying bonds. So the size of their balance sheet ballooned, but from a peak of almost $9 trillion, they have brought the size of their balance sheet down by $2.4 trillion over the last 2.5 years, and they have deemed it sufficient at this point to halt the process of quantitative tightening. Earnings for second quarter FY26 have been broadly in line. Earnings cuts have been quite limited. The better monsoons, the early festival season, and of course the GST Utsav have helped in lifting consumption growth and consumption growth expectations. But I would suggest we look at the data over the entire 3-month period, which is September, October, November, for which data is still coming in, to be able to ascertain actually how much of a pickup there was in consumption, because buying patterns did move around once people were aware that there was going to be a price cut. So people held back on consumption and now they have started to consume. Also, we don't know how much consumption has been brought forward. So we should not interpret a single data point of year-on-year growth for the festival season to be indicative of a revival in consumer sentiment. The final data for that is yet to be out, where we'll have to look at September, October, November together, and we'll also have to see how sustainable it proves to be. But certainly the environment is better, because remember, we had a fiscal benefit by way of an income tax cut in February. We have the GST cut, both of which effectively leaves more money in the hands of customers, and that in itself is certainly something that would aid consumption. Add to that, you've also got lower interest rates, with the RBI delivering rate cuts since the start of the year, and RBI indicating its comfort with stronger credit growth. So all of that put together, the backdrop is favorable, but don't interpret a single data point of just a festival season as being indicative of consumption revival. FY27 earnings growth estimated at 16%. Let's see how that pans out. As I said, the challenge is low nominal GDP growth of 8 to 10%. Will this recent inflation print give the MPC headroom to cut rates? Maybe. Hard to say at this point of time, but I would certainly say if prior to this inflation data, the expectation was very low for a rate cut in December, certainly the odds have gone up that maybe the RBI would have some headroom to consider a rate cut. But the cyclicality of inflation means that the lower print at this point of time raises the bar in terms of ensuring that next year's inflation print stays within the comfort zone. We've already talked about our in-house equity valuation index, which is at the border between increased equity allocation and fair value for equity allocation. We recommend staggering investments, and also risk management should be the key, just given the fact that I think global markets have been on a tear over the last 1 year. We need to be conscious of that. Hybrid funds are a great way to navigate this environment. I must say the value side of the market has surprised us by its strong outperformance in recent months, but I still think the strong cycle of values outperformance is now behind us. Its outperformance relative to quality has come off, and I do think we are in the early stages of a trend reversal in favor of quality growth. And finally, investors should adopt a staggered investment approach, which is what we have been recommending to people. So I'm going to halt at this time in terms of a wrap on the macro, and going to invite my colleague Sharwan Goyal into the conversation. He is the head of quantitative investment management and also passive fund management at UTI. He's been key to developing our proprietary integrated investing process, which combines our bottom-up score alpha investing process with quantitative signals based on the models that we've developed, which helps us identify which factor in the market we think is best placed. But I'll hand over to him, and he'll talk about the UTI Quant Fund, which is a very young fund because it's a fund launched only during this year. But we are quite excited about the prospects for quantitative investment and the IPR that we have developed in-house under Sharwan's leadership for integrated investing. Over to you, Sharwan.
Yeah. Thank you, Vetri. Thank you for sharing your insight on macroeconomic as well as on market valuations. So in a sense, as Vetri mentioned, that we have launched UTI Quant Fund beginning of this particular year. This particular fund is actively managed multi-factor strategy, which combines different factors based on our in-house model. So it basically combines and rotates allocation across various style factors mentioned here: momentum, quality, value, and low vol. Because when we study long-term performance trends of these factors, then we will find that longer-term performance track records of all these factors have been much better as compared to broader market. But generally, from short to medium-term perspective, they may witness cyclicality or volatility. So in a sense, this particular fund, because it is combining all four factors based on our in-house proprietary financial model, it removes the cyclicality associated with any particular factor from short to medium term perspective. So in a sense, during the course of presentation, I will first cover how major dynamics of these factors, single factors, and then in the second part of my presentation, I will cover how we are combining all these four factors in a single fund to deliver consistent outcome from long-term risk-adjusted returns perspective. So, in a sense, these are four broad factors which are wherein outcomes across different market environment could be very different. So, let me explain each of these factors briefly. As the name suggests, momentum is a trend investing. Here, based on equity market cycles, generally this particular strategy believes that if equity market trends continue the way they have been in last few months, then generally this kind of strategy perform well. So in a steady market environment, this particular strategy generally tend to do better. So this is a return and risk seeker kind of strategy, wherein as long as market trends continue, generally this particular style performs well. And the counterbalancing to momentum strategy is low volatility. We witness that typically every 2-3 years market goes through difficult phase. So as and when market witnesses extreme volatility and some bit of correction, generally low volatility style provides a lot of protection, because aim of this particular strategy is to minimize volatility associated with equity market cycle. So this kind of strategy could be extremely apt for investors who are slightly risk averse in nature, because long-term return risk-adjusted returns of this particular style is extremely better as compared to any other style. So while momentum and low volatility are more of a market-oriented factors, because based on price performance, the portfolio is constructed. On right-hand side, quality and value are more of a fundamental factors, because based on business fundamentals, the portfolio is constructed for quality and value. In case of quality, this particular style focuses on high quality companies based on 3 quality parameters like high return on equity, stronger balance sheet which could be gauged from debt to equity ratio, and consistency of profit growth in last 5 years. So in a sense, the major aim of this particular strategy is to identify stronger companies based on qualitative parameters and then construct portfolio of such companies. Generally, this kind of style delivers economic value through the cycle, and during volatile market environment, generally this style perform much better. The fourth one is value style, which is a bit of a cyclical style. Here, based on valuation oriented factors like price to earning ratio, price to book value, dividend yield, and yield price to sales, a portfolio is constructed of companies which are trading at lower than intrinsic value, or wherein companies are trading at extremely attractive valuation. So based on broader market indices, top companies are selected based on value parameters here. Generally, this style performs exceedingly very well during equity market recovery and during strong bull market. We have seen post-pandemic markets have gone through very exciting times, and this particular style has been the best performing style post-pandemic. But at the same time, this is slightly cyclical in nature. During equity market correction and volatile market environment, this tends to witness higher drawdowns. When we look at long-term performance track record of all these factors, then we will find that from longer-term perspective, all these factors have delivered much better outcomes as compared to broader market. In last 20 years, BSE 200 has generated close to 15% CAGR, while all these 4 factors have delivered somewhere between 17 to 20% CAGR, which means that they have generated somewhere between 2 to 5% alpha on annualized basis in last 20 years. Momentum has been the best performing strategy from long-term perspective, but at the same time, this is slightly more volatile in nature. When we look at volatility or risk associated with these factors, then we will find that low volatility style is having lowest volatility followed by quality, while value style is having highest volatility. So in the sense, risk profile of these 4 factors could be very different in different market environment. So on absolute basis, momentum has been the best performing factor, but based on risk-adjusted returns, low volatility style has performed the best, because returns are good, but at the same time, volatility is much lower as compared to any other style factor. So that's the reason why this particular style has done well from long-term risk-adjusted point of view. While long-term performance track record of all these 4 factors have been phenomenal, but the winners keep rotating based on different macroeconomic as well as equity market cycles perspective. This is a busy slide, but let me give you gist of this slide. Pre-pandemic, from 2017 to 2020 period, we have seen quality-oriented style doing better. But post-pandemic, because of very strong macroeconomic and equity market cycles recovery, we have seen value style coming to the fore. So from FY21 till late, value has been the best performing factor. Typically, style rotate every 3-4 years, but this time around it is slightly elongated as compared to previous cycle. But generally, styles keep rotating every 3 years. From FY 18 to 20 period, value was the biggest laggard, but in last 4-5 years, it has come back to the fourth base, mainly because of very strong equity market recovery phase. If I have to summarize the top table, wherein there are a lot of data, in that case, we will find that in the bottom table, wherein broader market index, which is BSE 200, is ranked 1 or 2 among all 4 factors, 19% times. While all these factor-based styles are having much better consistency as compared to broader market, because they are having somewhere between 40 to 50% of the time, they are among top 2 factors. So which means that from longer term perspective, consistency is much better for all these 4 styles. Among these, momentum is slightly better as compared to other factors. Now, another way to dissect these factors is based on market regimes, because certain styles perform well during tight market environment, while certain styles perform well during very strong rally and during bull market phases. So we dissected broader market returns into 6 different buckets based on 1-year rolling returns since 2005. And we found that pro-cyclical factors like momentum and value, they are performing well during market rallies. So on 1-year rolling basis, whenever market returns are in excess of 20%, which is bottom 3 bucket, typically momentum and value styles are generating very high alpha as compared to broader market. On the contrary, whenever markets are going through tough time, typically low volatility style and quality styles are delivering alpha as compared to broader market. So in the sense, based on market, in the sense outlook, one can allocate money across different style factors, because pro-cyclical factors like momentum and value are performing well during market rallies, while slightly defensive factors like low volatility and quality styles are delivering much better outcome during market corrections and slightly tougher market environment. Here we have constructed 1-year, 3-year and 5-year rolling alpha probability of each of these factors. One thing which is very clear from this slide is generally factors outcomes are much more stronger from 3 and 5-year rolling basis, because probability of generating alpha on 3 and 5-year rolling basis is much more stronger for each of these 4 factors, be it momentum, low vol, quality and value. Typically 3 and 5-year probability of generating alpha is higher as compared to 1 year. So that's why one should approach these factors from slightly medium to long term perspective, because near term they may go through difficult phase if market environments are not supporting some of these factors. So coming back to UTI factor allocation model, which is feeding into UTI Quant Fund. So we discuss how factors tend to do well in different market environment. So in next section, we will discuss the broad approach followed by UTI Quant Fund, wherein we are combining all these 4 factors dynamically based on our in-house proprietary financial model, which we call UTI factor allocation model. So let me throw some light on the approach that we follow in UTI Quant Fund related to multi-factor approach. So first and foremost, we found that among all these 4 factors, outcome consistency is much more stronger for momentum. And that's the reason why momentum is core part of our portfolio, while other 3 factors tend to have higher volatility as compared to broader market. So that's the reason why we are capping their weight at 70%. So allocation towards momentum could be as high as 100%, but we are capping other factors at 70% so that we have a diversified portfolio across different style factors. So when we studied performance of different factors like quality, value, momentum and low vol, we found that generally they follow 3 to 4 years cycle. So every 3 year plus minus 1 year style tend to rotate from quality to value and value to quality. So from 2006 to 8, value style has done better. In next 3 years, quality has done better. In next cycle, value has done better. So let me give you some gist on past 2-3 cycles, just to understand how markets have behaved in last few years. So pre-pandemic, from May 17 to October 20, quality style has significantly outperformed value as well as broader market. It has delivered 50% return as compared to 43% fall in value style. Post-pandemic, we have seen very strong macroeconomic recovery. And generally, as I mentioned earlier, generally during macroeconomic recovery as well as very strong equity market cycles, value tend to do better because starting valuations are cheaper, and generally these cyclical companies tend to generate a higher profit growth during good times. So that's the reason why they perform well during very strong recovery phase. So from October 20 to June 2024 phase, value style has delivered exceptionally high 450 odd% return as compared to 100 odd% for quality. In last 12 to 18 months, we are seeing trend reversal in favor of quality, although these are early trend, and in the sense quantum of alpha of quality versus value is not that high, but we are seeing style shift in favor of quality. There are a couple of reasons behind it. First and foremost, government of India as well as state government have a lot of thrust on consumption recovery in recent times. We have seen income tax rebate in the last income tax budget. At the same time, we have seen GST cut, which is providing indirect taxation benefit to the customers. At the same time, RBI is providing a lot of liquidity in the system. So all these measures could drive consumption recovery in next 2 to 3 years perspective, and which is typically most of the quality companies are more consumption oriented. So we believe that both from macroeconomic perspective as well as from equity market cycles perspective, quality style could do well. So that's the reason why quality is having higher allocation in our portfolio. Same is the case for momentum and low vol. So effectively, we are using mean reversion among all these 4 factors. We looked at previous slide wherein we found that between quality and value style keep rotating every 3 years plus minus 1 year. So rather than chasing a style which has already performed well for last 3-4 years, we build a model which is mean reversion kind of model, wherein we found we constructed relative performance of quality and value, and as and when quality has done well and it reaches value inflection zone, we start proactively shifting allocation towards value. And when value style has already played out and model is signaling allocation towards quality, proactively we shift allocation towards quality style. So just to highlight last couple of years cycle. So this was 2017 to 20 phase when quality style was doing better. So once quality performs well for certain period and to certain quantum, the allocation starts shifting away from quality to value. On the contrary, when in the previous cycle post-pandemic, value style has played out. So gradually allocation is moving from value to quality in this particular strategy. So rather than chasing a style which has already performed well for last 3-4 years, we use counter-cyclical process, and wherein based on mean reversion, we allocate higher allocation towards style which has gone through difficult phase in 3-4 year period. Same is the case for momentum and low volatility. While first decision tree looks at quality value trend, and while second decision tree looks at momentum and low vol indicator. So between momentum and low vol also, we look at relative performance of momentum vis-a-vis low vol. And if momentum has done well for exceedingly very well as compared to low vol in recent past, then allocation shifts towards value, low vol. And if low vol has performed better as compared to momentum, then model will signal allocation towards momentum. So here also we do mean reversion between momentum and low vol style. This is how allocation across different style factors have changed as per our backtesting results for UTI Quant Fund. So idea for this particular strategy is to identify cycles which could play out over medium to long term perspective. So that's why you are seeing that typically allocation don't change that frequently. So from 2019 to 22 period, when value style was playing out very well, allocation was higher towards value style. But in last 18 odd months, allocation has shifted back to quality. In fact, last 2 years, model is signaling higher allocation towards quality. And we have seen in last 1.5 years, quality has marginally outperformed versus value. So these are early trend in favor of quality. Current allocation is 70% towards quality, 20% towards momentum, and remaining 10% towards low volatility in our quant fund. So our backtested outcome suggests that rather than following trend, if we allocate money across different style factors based on long-term behavior of these factors, then outcome could be even better than individual factors. So in the previous section, we have seen that individual style factors have performed much better as compared to broader market. So along with those single style factor, which we have already discussed in the previous section, we have added factor allocation model, which we are effectively using in UTI Quant Fund. Here outcome is even better as compared to single style factor. At the same time, volatility is somewhere between all these 4 factors. So in the sense, aim is to deliver much better consistent outcome from returns as well as from risk adjusted returns perspective. So rather than chasing a style which is performing well based on longer term cycles of all these 4 factors, we keep rotating allocation across different styles based on our in-house proprietary financial model, wherein aim is to deliver much better risk adjusted returns. Generally, it's extremely difficult to identify when styles are likely to rotate. So if you ask me whether model can pick a particular time when style could rotate, answer is no, because the length and breadth of cycles could be very different from each other. Some cycles could be shorter, some cycle could be elongated, but typically it plays out over 3 to 4, 5 year perspective. So when we studied 3-year rolling performance of our backtested outcome, we found that the probability of generating alpha on 3 and 5 year rolling basis is somewhere between 94 and 98%, which is effectively aim of any quantitative strategy, that on a full cycle basis, it should have higher probability of generating alpha. So based on that particular philosophy, we have launched this particular strategy. So now the last portion is how we pick stocks. So as Vetri mentioned, that we have developed integrated investing approach, which combines strong research capability of UTI Score Alpha, and then that is coupled with or combined with UTI proprietary factor allocation model, which we have discussed just now. So we combine strong research capability of our investment process with factor allocation model to build the portfolio. So it's an actively managed fund wherein top-down allocation is based on different style factors, and then bottom-up stock selection within UTI coverage universe. So overall, we have about 460 companies in our coverage. So we have a 15-member research team which tracks these 450 odd companies. So this is broad universe for selection for UTI Quant Fund. So within these 460 odd companies, we first apply liquidity, size, and governance framework. So we remove about 120 odd companies based on liquidity and size factors. What is left is about 340 odd companies, which is effective universe for selection for UTI Quant Fund. So then we select companies from these 340 companies, top-down allocation based on style factor, based on our factor allocation model, which we discussed, and then bottom-up stock selection within these 340 odd companies. So as I mentioned earlier, the model is signaling 70% allocation towards quality, 20 odd percent towards momentum, and 10% towards low vol. So once it is determined that 70% allocation is going towards quality, now we rank all these 342 companies based on quality score, based on based on ROE, debt to equity ratio, and consistency of profit growth, which are quality parameters. So based on overall quality score, best quality companies are picked up, and then 70% weight is applied to those companies. Same process is followed for other two factors of momentum and low vol, wherein high momentum companies are picked up, and then 20% weight is applied. So it's a top-down allocation based on factor allocation model, and bottom-up stock selection within UTI coverage universe, which is designed based on UTI Score Alpha philosophy. So the current portfolio is around 2/3 portfolio is allocated towards large cap, while 1/3 allocated towards mid and small cap. In the bottom left table, wherein we have mentioned valuation as well as ROE profile of the fund vis-a-vis benchmark. Here we will find that although valuations are on expensive side, but at the same time, because higher allocation is going towards quality, so that's why return on equity, which is much better as compared to benchmark. In fact, it's almost 2x as compared to benchmark, while valuations are on expensive side because higher allocation is going towards quality style. Thank you. Back to you, Sonam.
Thank you, Shravan, and thank you, Vetri, for those valuable insights. Let's take up some of the questions we have received from our audience. Vetri, my first question is for you. Market seems to be gaining some momentum, fresh momentum, with benchmark indices moving higher, largely on the back of renewed trade deal optimism. How do you read into this development?
Well, Sonal, as they say, where you sit and what you think about determines how you look at the market. But the market doesn't speak. So nobody knows why the market is going up. Nobody knows why the market is going down. They can only ascribe reasons to it. And, we are not in the business of being soothsayers or forecasting what the market might do in a very short period. We don't claim any specific expertise to be able to do that. I think, India has underperformed the other markets if you look at it very specifically on a short-term basis, and that may be the result of that may have therefore caused, some buying interest to come in from overseas, and that's visible in the tilt that we've seen where foreigners went from being net sellers to, suddenly starting to look like net buyers. From a valuation perspective, more importantly, we are, at least in the large cap space, in the fair value zone relative to our history. But I don't have a strong view on, is the short term up or down, so I'm going to pass on that.
Sure. Shravan, coming to you, how does a multi-factor strategy like Quant Fund add value compared to a single factor approach? What are the key advantages of combining factors within one framework?
Well, Sonal, we looked at the presentation wherein we looked at long-term performance of single factors, and we found that long-term performance track record of single factor is much better as compared to broader market. But at the same time, single factor could have cyclicality associated with them. So near-term performance or short-term performance of a particular factor may go through difficult phase if market cycles are not favoring that particular factor. Multi-factor strategy combines all four factors in a dynamic fashion based on factor driven approach, which means it reduces cyclicality associated with any particular factor, and that's the best benefit of multi-factor approach.
Sure. When coming to you, what in your view will ignite the next big upswing in Indian markets? Will it take a broader growth acceleration, or do you see the revival being led more by consumption?
Sure. So let's tackle the last part first, because there's been a lot of discussion about consumption, and I mentioned in my comments as well that the setup for consumption, the cyclicality of consumption being positive is good, both in terms of the tax cuts, direct and indirect, leaving more money in people's hands, and of course interest rates coming down and credit growth starting to pick up. But it's very hard to see how you can make very large money in consumption given where the valuations are. The valuations are not particularly cheap in absolute terms or relative to history. Maybe relative to their exceedingly high valuations, in recent history, they have come down, but I would not describe it as an attractive opportunity. I think, Sonal, for me, the big key in terms of market performance is always a function of two things. Where are you in the valuation cycle? In the valuation cycle, at best in the large cap space, you're in the middle. And in the mid and small cap space, you're actually in the rich territory. So from one element, which is valuations, one part of the market is very rich, the other part of the market is reasonable. The second factor which contributes towards market outcomes is earnings growth. In earnings growth, we discussed 16-17% earnings estimate growth 1 year forward. I do think that is a slightly high bar. It's also a high bar because nominal growth in the economy is currently running in the 8 to 10% range and not in a 12%, 14% kind of a range. So I do think in this kind of environment, one must have limited expectations in terms of what equity returns can be. When we look at the last 4 years of equity returns, maybe those returns reflect P expansion. Now I would expect P moderation to be the name of the game, even looking at consolidated valuations. So single digit returns from large cap equities over the next 3 years to 4 years is what my operating premise would be. And honestly, on mid and small caps, I think it can be even lower, just given that the valuations are so rich.
Sure. Shravan, coming to you. For investors looking to build a balanced portfolio, how should they think about positioning UTI Quant Fund as a core holding or more of a satellite exposure?
Sonal, UTI Quant Fund provides you alternate way of portfolio construction. So in the sense, be it passive or actively managed funds based on fundamental approach of investing, wherein stocks are picked based on business dynamics of those companies. So it provides you alternate way of creating portfolio. So that's why one should approach multi-factor strategy like UTI Quant Fund as a core part of the portfolio. From tactical perspective, one can look at single factor strategies like momentum, quality, value, low based on investors' understanding of the market dynamics. So in the sense, while multi-factor strategy should be used as a core part of the portfolio, but single factor could be used as a tactical part of the portfolio.
Thank you, Shravan. Considering time is the last question taking. What's the key risks for global markets currently?
Sorry, Sonal, your voice is not clear. Can you repeat?
What are the key risks for the global and Indian markets currently?
Sure. So I think the key risk in the global environment continues to remain at some level geopolitics. One significant geopolitic risk, which is actually tariffs, seems to have faded into the background, so perhaps not as important as it was earlier. But we are still in a little bit of an unsettled global environment, so I would still say geopolitics remains something that we will have to be wary about. The other fact of the matter is that the US stock market, which is almost two-thirds of global equity markets, we looked at some of those slides earlier, is very rich in terms of valuations. And I think any setback to the US market just because of its disproportionate size and disproportionate outperformance will tend to send shivers across the entire equity spectrum. And that is something that I would worry about, that in a global context, global equity markets have both enjoyed a solid run, and the starting point in terms of valuations for the largest of the markets is not particularly good. In fact, I would say this is a historical valuation level from which market outcomes have typically disappointed. So those, to my mind, are the two critical risks to be watching out for: geopolitics and the US equity market in itself. These are the two critical risks that come to my mind.
Thank you, Vetri. On behalf of UTI Mutual Fund, I would like to thank all our viewers for joining us and for their active participation. We hope you found today's session insightful, both in terms of equity market outlook and updates and the strategy of UTI Quant Fund. Do share your feedback through the link provided. Special thanks to Vetri and Shravan for their valuable insights. Thank you once again for being with us. Stay informed, stay invested, and we look forward to seeing you at our next Equity Market Insight webinar next month.
Thank you, everybody. Thank you for joining us today.
Thank you, everyone. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.